So what is my weighting in digital assets right now? Well, firstly, I'm 100% weighted in Bitcoin within my digital asset portfolio. And why is that? Well, I own Bitcoin as a hedge against the fiat system. Right. And the only digital asset that hedges the fiat system is Bitcoin. Yeah. Everybody's a genius. Everybody's a genius in a bull market. In a bear market, that's where you see where the real cockroaches are. And there's never just one cockroach. There is never just one cockroach.
There's many.
Well, it's an interesting situation. So let's not forget that this is a closed-end fund. This is not an ETF. There is no creation redemption function to ensure that the net asset value of GBTC is reflected and trades right on its price. So it's premium or discount, and in this case, it is trading at a significant discount, is set by supply and demand in the market.
Right.
Now, one thing that I take issue with from that headline is if GBTC has to liquidate. The funny thing is, people who own GBTC already assume they own Bitcoin. So if GBTC turns around and has to liquidate, which I don't believe they will, the reality is the buyers of GBTC are already the people that own, of the Bitcoin are already the people that own the GBTC. You see, you have to unwind it from both sides of the trade. So a lot of these headlines are sensationalistic. Let's not forget that GBTC traded at a premium as high as 100%, i.e. twice the value of the Bitcoin that was held in the fund. And I want to throw out a scenario for all these fundsters out there where imagine you're a large hedge fund, or let's look at a long-term rather than hot money, a long-term investor like a pension plan. $6 billion is the current value of GBTC. $6 billion is a rounding error for a lot of hedge fund, lot of large pension plans. And I can think of a lot of them that need 1% exposure to Bitcoin, which is approximately a $6 billion investment. It would make a ton of sense to me as an arbitrage guy that I would start accumulating GBTC at these prices, i.e. a 40% discount, gain a 10% weighting, a 10% position in the trust, disclose that position to the open market, and then try to buy the rest of the trust at a discount so that eventually I own the whole trust, and then I unwind it and I put Bitcoin in cold storage. This is a possible strategy for some funds. One thing I'll take an issue with is there's a very big difference between being a 30-year-old risk manager, a la Sam Bankman-Fried and his CEO, Caroline, versus a 30-year veteran of risk management. Okay, there's a big difference. Barry Silbert is much closer to the latter than the former. The other thing that I would recommend that people understand in this, FTX was actually short Bitcoin. Okay, the world is actually short Bitcoin. Whether they are hedging other altcoins using the king of the castle, which is Bitcoin, that's the way markets work. You're always short the index, meaning if you trade a long short equity fund, chances are you're short SPX or the S&P 500 versus long position in single names. That's how you delta hedge yourself or call yourself delta neutral. The reality is most times you're hedged and wedged. There's no difference with a lot of these hedge funds in the altcoin space that are using Bitcoin as their short position versus their altcoins, which are less liquid, less valuable, and they try and control the mark to market by always being the bid to support it. That was the FTX story. I own Bitcoin in 3 different vehicles. Obviously, cold storage is my most important vehicle. But I also own Bitcoin in tax-advantaged Canadian accounts, so a purpose vehicle which allows for a tax credit and a Bitcoin consideration. So the way I like to consider it is the government or the tax authorities are providing me with a 50% incentive to buy Bitcoin. And then the third way I own it, which is in a smaller but not zero, is through GBTC. I've traded GBTC my entire Bitcoin career, which is about 7 years long now. I was selling GBTC when it was a premium because that's when you take advantage of the silly price, you sell a premium, and now I am picking away at the discount. People will write headlines as they try and create FUD and whatnot. Going back to the Luna situation, Luna brought us from probably 40,000 to close to 65,000 from the buying perspective. And then when it crashed down to around 31,000. But don't forget what else has happened since then, Paul. Celsius, okay?
Yep,
Three Arrows Capital. Bitcoin has held in there like a champ as far as I'm concerned. Bitcoin is at $70,000. Bitcoin, in my opinion, was cheap. I wasn't outright buying it with both hands. But the point is, people overthink this. Bitcoin is actually your insurance policy. And the fact is, the value of your insurance has gone up, but the price of your insurance has gone down. Should you be happy? Yes, sir, you should, because the world and the macro scenario has become a much riskier place globally since the Luna and Three Arrows Capital. Because if you look at other macro assets, I mean, Facebook stock or Meta is down. It was down 75% year to date as far as I look. So you get these headlines, you get the people who are Bitcoin haters. It's all good. It's what makes a market. But that I don't believe foreign markets are nearly as manipulated as the SEC may lean, if you will. I think it would have made sense, Paul, for this to happen sooner than later. But I'm not Gary Gensler. I cannot make it happen. And I actually I'm at least pleased there is a BITO product. Why? Because the price of Bitcoin would have fallen far faster and far more severely during the Luna and Three Arrows Capital scenario if there wasn't that short base of futures that are the other side of the trade for the BITO long position in the ETF. Well, obviously that's offset by a short position. So these things balance out over time. Liquidity in the market comes in various shapes and forms. I'm a believer that a Bitcoin ETF would be healthy. Spot ETF would be healthy for the US market because it would protect individual investors against some of the stuff that's happened on their exchange and everything like that. But it takes time for that to pass through the various channels in the USA. I never argue for having 100% weight in any single asset. I'm a risk manager. So what is my weighting in digital assets right now? Well, firstly, I'm 100% weighted in Bitcoin within my digital asset portfolio. And why is that? Well, I own Bitcoin as a hedge against the fiat system. Right. And the only digital asset that hedges the fiat system is Bitcoin. Okay. So my weighting amongst other assets like real estate, like gold, like common stocks, like bonds, I'm 20% weighted in Bitcoin. I used to be a little bit higher, but the price of Bitcoin has fallen. I do trade my core position. That is my mantra for 30 years of managing risk. I have core positions, but I do trade them. You need to have more than 0 Bitcoin, okay? Because Bitcoin is the best asymmetric investment opportunity I've ever seen. And therein lies the opportunity. If you have only 2% of your portfolio in Bitcoin and it achieves the price targets that I believe it will over time, your 2% is enough to hedge you against the rest of your portfolio that may be impacted due to the price rise in Bitcoin. There may be negative effects on the rest of your portfolio because Bitcoin is rising in value due to things that are having negative impact on the rest of your portfolio. So 20% is my Bitcoin allocation. The wrong answer for any portfolio manager is to have 0% in Bitcoin. Anything above 0 is the right answer, and then you have to adjust your portfolio accordingly to your risk parameters, including your ability to sleep at night. There's lots of people who own a lot higher percentage of Bitcoin than me. I don't feel I have to, again, because of the asymmetry of the investment opportunity. Exactly. There is an argument that I agree with, that the greater transparency or the greater regulatory involvement in the digital asset community will actually unleash pent-up demand for professional managers to gain access to that risk silo. A degree of regulation provides them comfort. In the case of Mr. O'Leary, no comment. I do know his history. He is a fellow Canadian. Let's just say that, perhaps his due diligence was a little lacking, but he's not the only one. What was really concerning, though, was placing your trust in a 30-year-old risk manager who you think has determined a new way to manage risk, when in fact, the only thing he did well was fraud, okay? Mm-hmm. So you got to understand what it is to sit in a risk chair for a certain amount of time, how you really understand how markets work, versus coming right out of MIT, thinking you're some sort of math genius. In fact, all you're doing is using customer assets as trading fodder, losing those customer assets, digging yourself a deeper hole, and hoping the market will eventually skate you on side. Criminal behavior begets criminal behavior. There are certain aspects of the due diligence that was taken by these major and very well-known private equity investors that can be questioned. But hindsight's 2020, okay? Yeah. Everybody's a genius. Everybody's a genius in a bull market. In a bear market, that's where you see where the real cockroaches are. And there's never just one cockroach. There is never just one cockroach. There's many.